Stay with us. Let's talk a little bit more about renting versus buying.
Joining us, Mr. Wonderful Kevin O'Leary, Shark Tank investor and CNBC contributor. What's your view of real estate right now relative to, would you buy a home these days if you were renting?
I think real estate is the worst investment idea anybody could have right now, just in front of rate hikes from the Fed.
Still,
I think
Kevin,
this asset
come
class
on!
is absolutely toxic waste, radioactive waste. Rent, do not buy. I tell everybody that. This is the time to be a seller. Sell into this market, take the dollars, invest it, make 4.5%. You'll never make that in real estate for the next 5 years. This is an asset class that people forget. For 15 years now, we've had nothing except rates going down. Of course real estate goes up in that environment. Of course it does. Watch what happens when rates go back up. Don't touch real estate. If Dolly was here, she'd be throwing stuff at me. I know that.
But what about rising rents?
She's talking.
What about sky-high rents?
Here's the truth about rents. You take a city like Boston, where I live, or New York City, you can still rent and impute a 30% difference. In other words, it costs you 30% less to rent a condo than buy it.
Kevin, I'm going to tell you something. Kevin, I just bought a condo.
Yeah, I mean, I didn't know if you were going to say that publicly, but I was just thinking of the irony in this whole thing here.
I mean, listen, at some point, the value proposition was actually a great one. I have to say, just going through it myself, maybe it's because, Kevin, you're in the middle of some really, really expensive markets in Boston and New York.
But it assumes that you're buying as an investment. What if you just want to live there? I mean, it's never going to cost this little as long as rates are this low before the Fed starts to raise, right?
For most people, their largest investment and their most illiquid is their home, whether it's a condo or a standalone home or an attached home. Of course it's an investment. That's why I look at it. It's 30% of their net worth, 40, 50% of their net worth. I'm just pointing out that there's room for thought and debate on this issue. That if you put about the same value of a house in a bunch of short duration corporate debt paying 4.5%, for the next 5 years, or bought a house, I think the bonds are going to win. That's what I think, and that's what I'm doing.
Yeah, but you're thinking about it as an investment. You can't only think about housing as an investment. Look, what are the most popular shows on HGTV? They're the ones where everybody's renovating. Remodeling is at an all-time high right now. Why? Because people love to do things to their home. They love to have fun with it. It's not only an investment. They love to pour more money back into it. And you can't do that in a rental. And you talk about Boston. I just talked to a real estate agent this morning. She said she had over 150 people at an open house 2 weeks ago in the snow. That's just common buyer demand from people who want to own what they live in.
Let's have this conversation after the first 25 BIP rips through the real estate market and people start to think about rates going up. It's highly sensitive to rates. Even 25 basis points can peel 10% off real estate prices. Watch it happen. It's coming to a theater near you.
I will say, Diana, what you're describing in some cases plays into Kevin's argument that this is a seller's market. Then, if you get that many buyers lining up right now, it sounds a great
seller's market.
Yeah.
It's actually a great seller's market because there's so little supply out there.
Not a problem. Not a problem. Wait, just give me one rate hike, and then let's get together again.
Well, what do you think is going to happen? I mean, isn't that the time people will be rushing in to buy because they do not want to miss the bottom in this market here, Kevin?
No, I think what happens in the first rate hike is you start to think to yourself, all right, I've been in an environment for so long where there's been no pressure on rates. It immediately shows up in the mortgage market. When mortgage costs more, there's less demand for housing. It's small incremental moves that have big impact on many markets.
Except that didn't happen last time around. When the Fed started to raise rates, it actually coincided with home prices moving up at a faster trajectory.
I think it's going to be different this time because we've had these sub 3% floating rate mortgages for so long now that you're going to see a lot of people say, yikes, I'm on a marginal basis here where I can't afford this anymore after 25 or 50 BIP rate hike. I'm going to sell my unit now.
But they're not floating rates anymore. The sub 3% that everybody refied into, those are fixed rates. More people have fixed rate loans right now, and that's one of the reasons they're not selling is because they don't want to trade up to a higher mortgage rate. These are not floating rates.
There's plenty of floating rate debt out there. People have been put into a place in their heads that rates will never go up, ever. And even we have this debate every day when we talk about the word patience in the Fed's language. Right. Rates are going to go up, and it's going to send a shockwave through the market. I think the volatility we're seeing in equities right now is anticipating the first 25 basis points. You can go back to 2004 and 1999 and see 6% swings in the indices when there was just talk of rate hikes increasing. That's why it's happening now.
All I'll say is my inbox is lighting up with people giving examples in their areas of how much cheaper it is really to buy than to rent. But Kevin, your point about ultimately what you'll be able to do with this property, given the history we've been through, is taken.
And you will still be invited to the housewarming. Don't worry about it. Kelly's going to do that.
There won't be any O'Leary wines. We're sort of a beer kind of household here. Thanks, Kevin, and thank you, Diana Olick, as well.
See you later.